Welcome! Today, we're breaking down the kiddie tax, one of the IRS's trickiest rules for families investing in their children's future. The kiddie tax is a set of rules under Internal Revenue Code Section 1G that was created to prevent parents from shifting income to their kids just to pay less tax. The kiddie tax rule was introduced by Congress in 1986 as part of the Tax Reform Act. The provision was enacted to prevent parents from transferring their income-producing assets, such as stocks or bonds, into a child's name. This effectively created a tax loophole for high-income families. When a child's unearned income exceeds certain limits, that income is taxed at the parent's marginal tax rate, not the child's presumably lower tax rate. Unearned income includes things like taxable interest, dividends, and capital gains. It's passive income or any money received from sources other than employment. Also includes taxable scholarships, income produced by gifts from grandparents, income produced by custodial accounts, such as UGMA or UTMA. Earned income, such as wages, salary, and self-employment income, is taxed at the child's standard rate and generally not part of the kiddie tax rules. Earned income may, however, trigger other filing or standard deduction rules. Wages from a summer job? That's earned income, and that's taxed normally. Investment income? That's unearned, and that's where the kiddie tax kicks in. The kiddie tax applies to most children under age 18, or turning 18 at the end of the tax year, and their earned income doesn't exceed half of their total support. Or full-time students up to age 23, if they don't provide more than half of their own support. Note that the kiddie tax may not apply if the child's earned income is more than half their support. The support test is important for the age 18 to 23 student rule. Also, the kiddie tax applies if the following is true. The child has unearned income above the applicable threshold. At least one parent is alive at the end of the tax year. The child is required to file a tax return for the year, or the parent elects to include the child's income on the parent's return in certain cases. The child is not filing a joint return, unless the child is only filing to claim a refund and no tax liability. The IRS adjusts the kiddie tax inflation each year. For 2025, the first $1,350 of unearned income is tax-free. The next $1,350 is taxed at the child's rate. Anything over $2,700 is taxed at the parent's marginal tax rate. For comparison, 2024 amounts were $1,300, $1,300, and $2,600. Let's see how it works. Brian, age 16, earns $5,000 from investments. The first $1,350 isn't taxed at all, that's the child's unearned income deduction. The next $1,350 is taxed at Brian's own rate, usually 10% or 12%. The rest, $2,300, is taxed using Brian's parents' marginal rate. In this scenario, the child would pay $135 in taxes at their own tax rate and $736 at their parents' rate. For a total of $871 on $5,000 of unearned income. That's the kiddie tax in action. See the difference? Without the kiddie tax, Brian's $5,000 might be taxed at 10%. With it, part of that jumps to 24%. First step to calculate the kiddie tax is to determine the child's taxable income. Take the child's net earned income, add the child's net unearned income, then subtract the child's standard deduction. If the child can be claimed as a dependent, child's standard deduction is calculated by taking the greater of the minimum standard deduction, $1,350 in 2025, or the child's earned income plus $450. The $450 amount is an inflation-adjusted figure specified by the IRS for calculating the standard deduction for dependents. Next step is to calculate the kiddie tax. Determine how much of the child's unearned income, meaning income from interest, dividends, and capital gains, is above the child's standard deduction. Then apply the Kiddie tax rules if unearned income exceeds the threshold and the age/support tests are met. To report Kiddie tax, the child files their own tax return using Form 1040 and attaches IRS Form 8615. This form compares child and parent rates. Alternatively, parents can elect to include the child's unearned income, interest, dividends, and capital gain distributions, etc., on the parent's return using Form 8814. This may simplify the filing, as the child may not need separate return, but can increase parents' taxable income. In summary, to qualify for Kiddie tax, the child must meet age and support rules, under 18, or up to 23 as a full-time student not supporting themselves. If your child is married, self-supporting, or earns most of their income from work, the Kiddie tax may not apply. The child will use the regular single-filer standard deduction. Say you open an investment account for your teen, such as a custodial account like a UGMA or a UTMA. If dividends grow too large, they can trigger the Kiddie tax. Unearned income from trusts or taxable scholarships can also trigger the Kiddie tax, so keep an eye on all sources. One way to avoid Kiddie tax is to save through a 529 education savings plan. Investments grow tax-deferred and earnings grow tax-free when used for education. Another way is through a Roth IRA for kids. The child must be under the age of 18 and must have employment compensation. Contributions cannot exceed earnings. Money in the account belongs to the child. Parents act as custodians and assets are transferred to the child when they reach the age of 18, 25 in certain state. Earnings can be withdrawn tax-free once the account has been open for 5 years and one of the following conditions is met. Child reaches age 59 and a half, death, disability, or qualified first-time home purchase. Keep investment income below $2,700 per child each year to stay clear of the higher tax. Also, some states piggyback on federal rules, others have different thresholds. Check state rules as well. Use this as a teaching opportunity. Help your child understand investing, tax brackets, and saving responsibly. To recap, the Kiddie tax limits how much investment income a child can earn before being taxed at their parents' rate. For 2025, remember that magic number, $2,700. Plan your child's investments carefully. Talk to a tax professional or use the IRS tools to keep your family's finances on track. In either situation, the tax must be paid by the federal filing deadline, usually April 15, to prevent any penalties or interest from accruing on unpaid amounts. Knowing the Kiddie tax rules help families avoid surprises and penalties. Understanding the Kiddie tax today helps your family make smarter financial choices tomorrow. It allows families to engage in effective tax planning and utilize tax-advantaged investment strategies. Thank you. Please subscribe, like, and share to help us grow the channel.